Welcome. Hi, everyone. It's so good to see you. Thank you for being here today. If you haven't yet, make sure that you're checking in using the QR code that's behind us. Welcome again. Thank you for being here. This is our panel or presentation on personal finance. We're really excited to talk to you, and I'm really excited to introduce you to some of the guests that we have for our panel today. If you don't know me, my name is Eduardo Pasos. I use he, him, his pronouns. I am an Assistant Dean of Student Affairs for Inclusion and Diversity here at the college, and I am a director of the Center for Multicultural Life at 30 College. If you haven't joined us to any of our events, I do invite you to stop by at 30 College anytime. And then we have Kristen here with us.
Hi, I'm Kristen Brennan, Executive Director of CXD. We've been together all week, so you know who I am. And in this conversation, I am a self-taught, avid consumer of personal finance information.
Hi, I'm Boris Rakin. I work for the Bowdoin Endowment, helping manage the endowment. And I'm here to hopefully talk a little bit about the investment side of personal finance.
I had a question in the previous panel about Boris's specific job. So just so that you understand, Boris is in charge of helping the college make the right decisions to purchase investments or to deal investments so that our endowment grows. So he's in charge of that growth and all of those things. So he's an expert in that area and works really hard to make sure that the endowment is working for our students' financial aid and comprehensive aid generally. So we have a Menti. I think you have been using Menti throughout the week. And I have a very first question that I would hope to kind of throw at us to just have a super quick conversation on before we get started with some of the specific content. Growing up, my family talked about our finances a lot, somewhat, or not at all. And just go to menti.com and you're going to use that code right there, 33469386. Log on to Menti and just tell us, growing up, my family talked about our finances a lot, somewhat, or not at all. I would love to see the survey of this room. All right, we have about 50, 57, 63 people. Great. So pretty similar to last hour's panel as well. The majority of people found themselves at the somewhat, some people at the a lot, and some people at the not at all. I would love to ask you a question, and anyone, if is willing to answer it. What was it like growing up talking about finances in your family? Did you guys talk a lot about it? Did you not? Was that something that was kind of kept hidden from you, or were you incorporated into the conversation? Were you a part of it, or completely separate from that conversation in your families? What was it like talking about finances in your family growing up? Who would like to start? Anyone want to start? Yes, please do.
It was like definitely really important, and they made sure to like understand from a young age like how coming from a lot of poverty, like being in the situation that I am is really a blessing, and like how I have to make sure to ensure that like the generation that comes after me continues to like live a better life than I am.
Yeah. I love that. So for your family, finances was a tool to think about generational wealth or generational change, right? I love that. One more person. What was it like growing up for you or your family to talk about money? Yeah, please.
Yeah, I think we talked about finances a fair bit. I appreciated the transparency from like my other family members in the sense that I felt like I also had a role in sort of making financial decisions for my family.
Love that.
Just being a part of that made me feel kind of like responsible in certain ways, and now just I also feel like quite comfortable thinking about finances and making financial decisions.
Thank you for that. Is there anyone that maybe didn't talk about money at all? Not at all. What was that like for you? If that was not a topic that you guys ever really talked about. Yes.
It was kind of stressful, definitely. I
Yeah, thank you for that. All right, second question for us. Thinking about my finances after college makes me feel, fill in the blank. What does it feel like to think about your finances?
Gonna page down so we can see them.
Thank you, Kristen.
Sure.
Stressed, confused. I see the running joke of the week. Worried, anxious, queasy. Terrified, nervous. Fucked, anxious. I'm already in debt. Hyped. I like hyped. I know there's really only just one that's hyped, but all right. Any thoughts or reactions to that? Any comments? What does it feel like to think about your finances after college? Unprepared. Who said unprepared? Tell me more. How come?
Because, well, for me, growing up, my parents never talked about finances because, they're too young to understand any of it.
Yeah.
So I feel unprepared.
Yeah, it's funny, right? Sometimes we have that approach. We're like, oh, you're a child. You don't know anything about this. But then we send you to college, and you're supposed to be making money afterwards and be making these big decisions, and no one ever told you anything. Anyone else? How else does it feel like? Yeah.
Feels like the first thing I need to think about when I'm thinking about a job is how much money I'm going to make.
We're going to talk exactly about that. Absolutely. Yep. How much money you're going to make after college matters. It's not the only thing that matters, but it matters, right? All right. So we were talking earlier, and I would love to hear some of our thoughts as well. Why is it hard to talk about money for us, Kristen and Boris?
Yeah, because oftentimes it's seen as very personal. It's not something that people usually share.
Yeah.
What we've heard here in terms of how parents often don't discuss it with you, and because it's not an easy topic. A lot of people are anxious about it.
Yeah.
Yeah.
That's right.
I think kind of no matter how much of it you have, you come, from different places about why that might be difficult to talk about.
Yes.
Difficult to talk about why I can't afford to do the thing you can afford to do on this weekend, or difficult, my college roommate was like, I couldn't possibly tell you that I was going to be a debutante. I didn't know what you would say in response. And we've had that conversation like now 30 years later, like, yeah, she's right. It was hard for me to like understand that perspective. So there's kind of, no matter where you're coming from, there's,
Yep. If you're wealthy, it's hard to talk about money.
if you're not,
you're low
hard,
income.
hard to talk about money.
Yeah, for sure. And what's the connection between talking about and managing money and social justice? What do you think?
I think it's kind of a similar point, which is I think it's important. If you can't talk about it, then it's hard to know enough, and then it does kind of affect whether social justice can happen.
Yep. I love that, and sorry to put this in your own words, Boris, but for Boris specifically, his job is to help us make money in the endowment so that we can give more financial aid to students, right? So your job is entirely connected to social justice. We're not trying to make Bowdoin richer. Most of our endowment goes to financial aid, and we spend it that way. So the more money that we make there, the more we can help students. So there's a big connection there.
Yeah. I think I really appreciate how one of our panelists just like put this out last night. It's like, I'm going to talk about what I made at my last job. I'm going to talk about why I'm making it my new job, why that difference matters, how that actually allows me to make important decisions. I think the less transparent we are, the less we can use each other and our knowledge to sort of advocate for ourselves or advocate across different industries for pay.
Salary transparency is one of the most effective tools to produce social justice and pay equity across different demographics at jobs, right? And as long as we keep on the secrecy of no one knows how much anyone else makes, then we will persist with cycles of oppression, like women making less than money and BIPOC folks making less than white employees as well. So yeah, talking about money will be extremely, extremely important. And then lastly, what did you learn from your family talking about money?
Yeah, so for me, first of all, I come from the former Soviet Union. And I grew up there when it was still the Soviet Union. So there was no concept of money. It was a completely different system.
Yeah.
So when we came here, it was a combination of the fact that we were poor immigrants and there was no money at the time, but also learning about the system. So I think for me, along with my parents, it was learning about the system and about capitalism and about money over time. So coming from that background, it's different.
I think my family had this kind of working class narrative about the number of generations it had taken to get to a point where like I was going to college, or where things like food and rent were not something we worried about weekly. And I had an understanding that was a good place to be. And always thought though about how much things cost. I was just very conscious of how things cost. And in middle school, my parents got divorced, and then I really became conscious of how things cost and started to think about things like college, because it just takes more to support. So at that point, actually had a pretty explicit conversation with my mom, who was like, had I known this is the way things would go, even in the best of circumstances, which they were, I would have taken a job that made more money, and I would definitely make sure you always are the one who knows what's happening with your money. It's not that there was anything happening in my family, but I've seen too many times women in particular who outsource that and wish they had not at some point.
It's interesting you talk about divorce. There is also a correlation between divorce happening more frequently at lower middle income and lower income families than at higher income families, right? So divorce even is a function of socioeconomic status and class in interesting ways. For me, I grew up in Mexico. I'm also an immigrant to the country. So thinking about money and being the only person of my family that is here, everyone else is back in Mexico. I also didn't have anything at all coming into the country. So I had to learn absolutely everything. What I love about that, at least, is that you have at least a couple of examples of folks who didn't know much or any at all about investments or budgeting or finance, but were able to have some kind of a working knowledge, even if it's self-taught, like Kristen and me, about finances and how they impact our everyday life. So Kristen, this was your idea from the last 2 or 3 years. You've been thinking about a panel like this. What's the big idea behind this conversation?
Yeah, I've been having like an informal version of this conversation with you, and then Boris and I had a version of this conversation at lunch. And when you think about what can we do in 75 minutes, there's so much you can read and do, and I think we're just kind of whetting an appetite to go and do that follow up and get interested and get curious and make it possible to like access that information. But I think what we're also doing is providing, human beings are not completely rational actors. Behavioral economics is devoted to this. We have feelings about money. It matters to us. It's personal, and so we're always, sort of in a situation where we might be, there we go, I don't know where that's going, bump, there we go. Kind of dealing with like FOMO, like, oh, everyone else is investing in that, maybe I should be. Or, our concepts of what we need. What do we really need? Or, the difference between people are kind of like, why worry? It's all going to work out. Or the sky is falling tomorrow. What we're hoping is that this is some guardrails, metaphor, so that you have a few principles to fall back on or frameworks to think about that might help you kind of navigate when those feelings are present and you're trying to figure out what's the best decision I could make.
And resources too, right? And
resources, yeah. We have a whole section actually of resources after this. Feel free to check out that we've posted. They're in Handshake, but your list of resources for Bootcamp Hub takes you right there. And when you go to sort of financial wellness and that topic, we've curated a set of really like credible, defensible, either they're in the business of finance education or they're credible actors like our own plans here are managed by Fidelity. So they have a lot of good education. You can go deeper and check it out.
And then we are also resources for you either after this conversation or throughout the semester. Boris, of course, being an expert in investments and finances in general. Kristen and I are not experts, nor are we investment advisors, but we both have done a lot of learning and thinking and reading about personal finance on our own lives and budgeting and stuff. And speaking of, Kristen, how do we actually know how much money is enough?
Yeah, that's a deep question, right? Like, how much is enough for whom, and at what point in your life? But I do think, how do we know how much is enough? Is we budget.
Yep.
So I have this conversation with folks a lot. Like, I think I have to make a lot of money, but it's always kind of abstract. It's like, but I don't know how much I'll be making or how much I'll be spending. And that's the beautiful thing about a budget is it's built to do exactly that. So first I'll just say, in this kind of what will I get paid transparency piece, that there are a lot of resources, salary.com, Glassdoor, ONET is a federal database, where you can go and somebody maybe just suggested to you, maybe you want to look into this field, and you're like, I have absolutely no idea how much that pays. You can find out. Like, it doesn't have to be a mystery how much it pays and what you'd actually make per month, per year in a job. So that's your, kind of first line. And then you really can size, like, how much am I going to spend? We actually built a budget tool to do this, a couple of us on the team who have built these for ourselves. There are lots of tools on the internet, but I like the one where you can see what all the boxes, what's in all the boxes, and control what's in all the boxes, because it's your life. So you can choose, like, am I in a big city with a roommate? Am I in a small town where I can afford to live on, so you can put in all the variables, and you can just see, and you can set a goal to save. So I think the answer to how much do I know is enough is a budget, and then you can actually know, you can have some peace of mind, and you can set savings goals.
In some ways, you almost have to reverse engineer it. It doesn't,
Yep.
like, how much is enough in Kansas is
Yep.
going to be very different than in San Francisco.
Yeah, and how much is enough given my goals? So if I have, for instance, a commitment to support my family in a
Yep.
certain way, that goes in as one of your top lines. It
Yep.
doesn't come out at the bottom when you see if it's enough. You put it in first to make
Right.
sure it's enough.
Right.
So, yeah. And then, on the topic of saving, I mean, I think the reason it's important, part of the reason a budget's important is it lets you save, and it doesn't become an afterthought. And I think the reason that's important is that savings are freedom. So I always have a really hard time having conversations with people who are like, but I can't leave this job. I don't know how I'm going to pay the rent. Or I can't leave this, even worse, relationship, because I'm sharing the rent with this person that I live with. Like, that is not a situation you want to be in. So you want to have enough to break the lease. You want to have enough to quit when somebody asks you to do something that's not ethical. And so money is like, what's enough money? It's enough money to walk out of one of those situations and to a new one,
I love that you have a feminist perspective of savings.
I really do.
Yeah.
I have, had enough people in my extended family, like, be in that situation, right? You don't want to be there.
Yep.
So, yeah, I think it is really important. It's empowerment, which gets to, like, how to actually save, because it's not easy to do. So luckily, there's actually a bunch of research about human behavior, about what makes it easier to save. And so why not make it easy on yourself? One of the tricks is to pick a place you trust with your money. So there are plenty of trustworthy institutions. Luckily, we have all kinds of nice guardrails in the US. But I say, go check out a credit union. I always, whenever I'm looking for financial information or financial services, I ask, what's the deal? What's this person's angle? For the most part, the angle is so they can make money off of my money. That's how finance works. I would like to start with a place whose deal, at least in part, is consumer education or small investors and small business people, which is what credit unions are for. You're often a member instead of just like a client. They tend to pay more attention to your teeny-weeny account. Mm-hmm. And generally you can get some good advice and some good initial sort of starter products, whether that's like a debit card or account or a couple different, they tend to be big into savings accounts and maybe give you a little incentive to do it. So check out credit unions. You don't have to be anybody. You can just look in your local neighborhood and find some. Sometimes there's, you have to be a veteran or something, but usually not. And then making it automatic. If you've got a second account, a savings account, and the money comes right out of your paycheck and gets routed directly there, even if it's $10 at first, you never see it, you never missed it. So you don't have trouble saving it. And you pretend it's not there until you need it. And then the other thing that's known is that a goal can be motivating. So if you're saving for a something great to do for yourself, a vacation, but also like you're trying to get to a certain amount in your emergency savings, that is an incentive and it tends to work. So speaking of emergency funds, which I talk about how passionate I am about emergency funds, what do you think is the best target amount for an emergency fund? How much do you need in there? Let's vote and see. The choices are $1,000, 3 to 6 months of living expenses, 3 to 6 months of salary, or enough to break your lease and pay for the first and last month of rent. What do you think? Let's see what's coming in. All right, and these are like point values, like you can see which one's more popular by the scale. Great. So we've got 3 to 6 months of living expenses pulling ahead with a few others kind of duking it out. It's really interesting, across conversation, I think some of this is like what advice people have read, what article. So actually, any of these is a good number. There's a couple different ways of thinking about this. I think one really good way to think about this is you start with $1,000. You say, why $1,000? That's a pretty arbitrary amount of money. I think it feels achievable. You can imagine getting there, even $10 at a time, $20 at a time. And it's also maybe about the amount of money of like a pretty common disaster.
Yeah.
My computer broke. I need a new set of tires. Something that you're like, I do not want to have to put that on a credit card. I just want to be able to do it. So $1,000 feels achievable, and then it's probably like good insurance against like the first kind of common disaster. And then once you've done that, you've got like success you can build on. So you pause. If you do have credit card debt, you pay it off. So you quit paying more money than you need to on that, because you're paying interest. So once you've got that taken care of, then you can start saving 3 to 6 months. A lot of people say expenses, because basically you're thinking like, okay, if I didn't have a job for 3 months or 6, if it takes me a little while to get the next thing, can I just pay for the things that are going on in my life? That's a pretty good goal. But the other goals, there's nothing wrong with them either. It should make sense to you. You should be like, what could happen? And how do I have enough set aside for that? So if it is like, I think the most likely thing that might happen to me next year is I'm going to break my lease. Well, because of a aforesaid person I don't want to live with. Well, that's probably the amount you need to save. 3 to 6 months of salary is great if you can do it above living expenses. So any of those can be good as long as they make a whole lot of sense to you, because again, it's your goal you're saving for. And then one other thing you can do to protect yourself is insurance. So insurance, like anything else, is just a product, right? You're buying it. You're paying for it. So what on earth are you paying for? You're paying so that they pay instead of you whenever the disaster comes along. And whether it's health care or it could be disability or certainly car insurance, rental insurance. So the good news is that once you get a job, in most cases, they should be offering the most basic insurance that you're going to need. You can tell what is the basic stuff you need because it's going to be in your sort of set of offerings from your employer. But what they usually don't offer is car insurance or renter's insurance, which of course you have to have car insurance to drive. You sometimes have to have renter's insurance to rent, depending on the terms of the lease. So I would say those are the other couple common ones you just want to know, research, and go ahead and buy. And like anything else, keep remembering that it's a product. You're not like a hostage to it. Like you get to decide. So just like when you're getting an appliance or a minor electronics, and they're like, "Do you want the insurance plan?" You're like, "Depends. Like how long does it last, and how likely is this thing to break?" So you want to not overpay for this, but you want to think about, can I afford like kind of the most likely things that might happen that would be really expensive? Like that's what insurance is for.
You were talking, go for it, Boris.
No, I was just going to say that to your point before that, insurance companies also are there to make money, and they have hundreds of actuaries that determine how much you're going to pay, and that is determined for them to make money, as you said.
Right.
So very often, I think you have to determine whether you really need this insurance, and oftentimes it doesn't statistically make sense. But
Yeah. Absolutely. Yeah, it's a product. It's a product.
And you were talking about the 3 to 6 months of savings of your regular expenses and savings, and that made me think. Just earlier in the morning, I was reading the headlines that Google was announcing the layoff of 6% or something like that of their workforce, right? So not to scare you or anything, but layoffs are a part of normal business. They happen all the time throughout a decade. They just go up and down, hiring and laying off. So that's a really good way to kind of protect yourself, right? If you were to get laid off from your job, can you survive 2, 3, 4 months while you're searching for another job without having to get into terrible debt?
Yeah, and our panelists, some of them last night, talked about sort of like what it takes to sort of get your courage up to do something like this, but the importance of being able to make a move. That's what it allows you to do. Make a move if you need to make a move.
Right. So the next question, Kristen, is does it make sense to take on debt ever? Is there such thing as good debt?
Yeah, so I will say I am, if you can't tell so far, risk averse, debt averse, and I did not like the idea of having debt. It happened because I went to college, right? And I actually had a place with generous financial aid like Bowdoin, but at the time, this was no loan packages. So it just came with a loan. So I was like, all right, this is what I'm going to do to go to school. Seems like a good investment. Even then, I think I understood that the idea that you are investing in yourself, right? This is something I need that I think is going to put me in a good position in life. And I think housing is similar. You think most of the time my house is going to appreciate. So rather than just paying rent, maybe I could have something at the end. I can't afford to buy it all at once. I just couldn't. Actually, the 30-year mortgage is one of the most sort of progressive policies to come along this century, right? It's like to say, I can buy a house, I'll pay you over 30 years, allows you to do something.
Most countries is 10 to 15.
So it allows you to do something that you wouldn't otherwise be able to afford. So that's a good debt, I think. And then you've got car, which just kind of is. Like, who can generally, right, buy a car out of pocket? It's like, what you're basically doing with car is like a little bit different. You're basically like just paying for that car over 5 years. But some of this stuff that's 30 years, it's like there's no way you could have paid that all up front, but it has value. So again, you're looking at what's the interest rate. It's a product. What am I going to be paying on this thing? But it can make a whole lot of sense in a few cases to take on debt, which, you know, given that you got to do that, then you have to care about something called a credit score. Anybody heard of a credit score? Who's heard of a credit score? Nice. Did you know that you might have one even if you've never seen it? So you can find out what it is. It's not a secret. They made them do this for free. You can go to annualcreditreport.com and find out your credit score from all three. There are 3 agencies, count them, 3 agencies chock full of people who are all like determining your credit score. And it should be probably pretty similar across the agencies, like in a similar zone, but you can find out once a year for free. Let's talk about good credit and what it gets you. So you want to have good credit. We'll talk about like a concrete example of why in a minute. But what would you guess affects your credit score? How credit worthy these agencies think you are? Do you think it is how long you've had a credit card? Is it how much of your available credit you're using? So say your credit card is like for $5,000. Does it matter if you've quote unquote maxed it out at $5,000 or you're just using like 500 of it? Whether you pay debts off on time and then shopping for new apartments, like being on a shopping spree for apartments and cars, just like checking them out. You're not even buying them, you're just shopping. Which of these things do you think matter? So we hope whether you pay debts off on time matters, right? Like these people are trying to figure out whether they should lend you money. So it ought to be the most important thing.
Yep.
Interestingly, it hangs in there along with some of these other factors. So it does matter how long you've had a credit card. I had access to an emergency credit card in college. Hardly ever used it. It was my mother's credit card. I still, to this day, the credit agencies, when they put it out, it says, this seems interesting that you've had this for so long. We think your real credit history starts like when you got your own card. So it is on there, and once you get your own card, they know it's your own card. But they look at, of course, like, is this a fluke that you managed to pay things off, or you've been paying things off regularly over 20, 30 years? How much available credit you're using? They don't want you using $5,000 of your $5,000 of credit. They want you using 30% or less of your $5,000 generally. And then interestingly, weirdly, sometimes you just got to shop for cars or apartments. You're just doing that. If you kind of just do it for fun, willy-nilly, they have to run your credit every time. And so the credit card company starts to wonder, like, what on earth are you preparing to buy that you've like gone all these places and had your credit checked a jillion times? So it actually does matter. It doesn't matter so much that you should be terribly worried about it. But fun fact, it actually does matter. So those are kind of some of the things you can do, even today, to start to think about credit score. And then it affects how much you're going to pay for a car. So we could do this in NerdWallet, but I'm just going to talk about it instead. We're getting a new, well, no, we're getting used. This is going to be too ambitious. We're going to use Honda Civic. It's still $20,000. So we're going to get a used Honda Civic. So if you have the best credit there is, like, we're calling it super prime, whatever it is, best super prime. What you pay for your car every month is going to be different than if you have lower levels of credit. To just, give you a little picture of this. These were taken a few days ago, so the rates may be slightly different today. You can look it up anytime you want. NerdWallet, I like NerdWallet. But you're gonna, if you have the best credit there is, you're gonna pay $450 a month for your car payment. If you have less and less good credit, you're gonna pay maybe as much as $100 more per month. And so, of course, that matters. Like $100 a month is real money. But it also means that over the lifetime of that loan, you're going to pay the people who made the loan $6,000 more as a subprime borrower than as a superprime borrower. And that's, on a $20,000 car, that's a lot of money.
And something that I think it's counterintuitive is that you might think, oh, well, I've never taken out debt. I don't have a credit card. I don't owe money to anyone. I should be good after college and get myself that $20,000 Honda Civic, right? Actually, no. If that's you, if you've never taken on debt, if you've never had a credit card, if you haven't improved your credit score, you're going to come out at the non-prime. You actually have to work at increasing your credit score in order to be able to get the cheapest super prime rate, which is hard, and it just means that it's something else that you kind of have to think about as you're thinking about your finances after college.
Yeah, because they don't have the resources to find out if you've paid your friend back $10 last week. They can only see like this information that's kind of commonly in the system. So yeah, it is strange. You think the best thing you could possibly do is just never have a credit card, but you want it to build credit, and you also want to have it because if you ever are making a purchase that turns out to be dodgy, your credit card is covered by the Fair Credit Billing Act. Responsibility limited to $50 for goods and services not delivered as agreed. So what happens is that means like your credit card company is on the hook, and they don't want to be on the hook, so they call you and they're like, what is this? Or I was at the farmer's market, I bought 2 jars of salsa because I forgot to, and went back for the second one. They were like, this is the same purchase twice. Is this questionable? Like, they do not want to be on the hook for your $5. So basically your liability tends to be zero. Like, they deal with it for you, whereas your bank is subject to a different set of laws, and you could kind of be in this for a while if you used your debit card for something that turned out to be like not so great, fraudulent.
So that's what we do with when we have money, right? Budgeting and saving. Boris, what do we do when we have extra money?
Ooh, that's a link.
We've talked a lot already about saving. I guess the saving is basically putting cash aside in a bank account, and the nice thing about that is that it's risk-free, essentially. The government insures all bank accounts up to about $250,000. You do today, a few years ago or a year ago, you would have gotten essentially 0 interest rate on that saving. Today, you actually do make, in some accounts, as much as 3% or more in savings. So obviously, to the extent that you think about investing, which would be taking risk with your money, you have to first think about, am I going to get paid more on that investment than the 3% that I'm getting risk-free in the bank? So that bank rate becomes kind of a hurdle rate for all investments. So as you think about investing, therefore, I think before you get there, as we've sort of said before, make sure that you have taken care of this emergency savings, make sure that you've paid off your high interest debt, and then make sure that the money that you're about to invest is something that you actually don't need for many years. Yeah. Markets are volatile. Investments are, by nature, they can go down in value. You can even potentially lose that money. So it's only meant for money you don't need for quite some time. So then, as we think about the types of investments you may want to consider, this basically gives you, what we're doing here is looking at the trade-off between the risk of an investment. So these 2 particular columns, starting with cash-type investments, which are very similar to savings in the terms of risks, right? They're, let's say, T-bills, which are short-term loans to the government. They essentially have also 0 risk, and they make similar returns to what you can get in savings accounts. As you go up the risk spectrum to bonds first, so these are loans that you make to governments or corporations, you start getting paid more, but then you do have risks of losing money. You then go further into, say, buying properties, such as apartments or houses, to rent out to people. that's yet a further kind of level of risk. And then finally, you get to stocks, which are essentially partial ownership of companies, Walmart, Google, Amazon. And there, you have substantial risk of loss. In a year like 2008, 2009, the overall stock market lost 57%. And then you also, on average, every 4 to 5 years, the stock market is actually down. So you have to make sure that you, again, are prepared for this type of losses. But the return that you make, especially over long periods of time, makes a lot of sense. And then I guess these are all individual investments. And in addition to that, I'd say most people actually invest through funds. So funds are basically pools, baskets, portfolios of individual investments that allow you to diversify, through one purchase, diversify your capital across a broad range of investments. The example of that, for example, would be, let's say you may have heard of the S&P 500 index fund, which basically allows you to invest with one investment, invest in the top 500 companies in the United States. And that's kind of the number that we've shown here is that 10%, which is the long-term return on that. And then I would say the one area you may want to start, especially if and when you get a job, or when you get a job, the likelihood is that your employer will provide you with a type of retirement plan called the 401k plan, which gives you the ability to buy funds in a tax-efficient way. And your employer will often match your contributions to that account. So it makes a lot of sense in that situation to at least to start your investing by maxing out your contributions at least up to the level where the employer is matching them, because you're essentially doubling that amount that you're investing. So that gives you a sense for the types of investments, the risks, and kind of where you may want to start.
So to put it in a real case scenario, let's say I'm a senior right now and I got $1,000 this holiday season, and I know I'm going to go to grad school. Should I and I'm going to need that for when I'm in grad school. Should I invest my $1,000 that I'm going to need in August, or should I do something else differently with it?
Yeah, I think to the extent that you have short-term needs for that money, you definitely don't want to be putting it at risk. As we said, it could easily go down and it would force you to essentially sell at a disadvantageous point in time. So definitely on things where you cannot make that commitment over the long run, you should not be risking it. Yeah. Certainly should not be putting it in stocks.
But if the $1,000 are just extra, really extra, and I'm like, I'm going to think about this for retirement or for 10 years from now, it would make sense to invest it.
Absolutely, yeah. And exactly. So that's exactly what the test that you may want to apply into deciding how much you put aside to invest.
So a really popular conversation right now is the idea of crypto and NFTs. What does that fit in with all this?
Sure. So I guess that sort of that goes to this kind of distinction between call it a prudent investment and what may qualify more of a speculative investment. So as I think about that definition, I think first and foremost about a good test would be, do I know if I at least get my money back when I invest in this thing? And what is my level of confidence in that? And what is that confidence based on? So one good place to start is investments. As you think about investments, they typically provide you with some real cash flow, real earnings. And on that cash flow stream, you can kind of figure out, am I paying too much for that cash flow stream, or is it reasonably valued? Mm-hmm. For more speculative investments, very often, they're not providing any cash flow stream. They're more following the model of, I think that this is a hot investment that perhaps could, follows kind of this greater fool theory, where if given that it's hot, someone else will probably buy it from me at a high price. So by the way, very often those types of investments are the ones that you see on social media or that friends might be talking about. And there's a reason for that. I think the people that are more engaged in that speculative activity are the ones that are more likely to kind of advertise it more broadly. And then so you get things like the YOLO, you only live once, FOMO, meme stocks. So I think it's not, I'm not saying that don't listen or don't read this kind of stuff. And I would just say, try to do your own work. Don't borrow other people's convictions, because those convictions will be tested by the market. Yeah. And know what you're investing in, right? So in the case of crypto, I think if you think about the crypto itself or things like NFTs, it's very hard to figure out what is the right value at which that you should pay for it. Yep. It doesn't in itself produce any cash flow. So it's very hard to value that. And so I would, at a minimum, put it in this sort of too difficult bucket. Yep. In other words, probably speculative, probably, certainly if you put some money into that, it would be a very small percentage of your portfolio.
And very different than a company that has a portfolio that has assets, that has businesses, that has been bringing in money, and you kind of have a general idea of how much the company is worth.
Exactly.
Yep.
Yeah.
All right, so I know we've given you a lot of theory, a lot of numbers and data for the last 20, 30 minutes or so. We would love to take a quick second to see if there's any questions so far that any of us can answer. Anything that maybe was not clear, or anything that sparked your brain. Is there any questions? Yeah.
I have a question. So I believe last year I kind of opened a Roth IRA for the first time.
Sure.
And I was like, I don't really know what I'm doing right now, but let me just put $50 in there.
Yeah.
Invest it in the S&P 500 index fund and see what happens. And for me, I just noticed that I never ever got back to $50. It just seems to keep creeping lower and lower.
Yes.
I think right now it's at 43, something like that.
Sure.
It doesn't seem to be going up anytime soon.
Yeah.
I know it's supposed to wobble a little bit, but it looks like it's just going down straight. So how do you deal with the kind of anxiety? Because knowing that it's a long term, 10, 20 year type thing, but being discouraged by being oh no, all the money that I
My $7. Yes, I hear you.
I just had this conversation with Fidelity. I did.
Blame it on Fidelity.
No, I mean, it's not their fault. It's like, help me steel myself for this, please. Yeah.
Yeah, no, I think, so one chart that I think is helpful on that front is, look, you're absolutely right. I mean, I'd say we talk about kind of long-term returns on stock being very attractive. So this particular chart shows that this is almost 100 years worth of data. So we're talking about any given point here is looking 10 years back, what the return was over that 10 years. So you can see that even though the mean is, call it about 10%, you are almost never earning that 10% mean. You're almost always either making very little or actually losing money, or you're making a lot. So that's, markets, as you can see, go through these fairly clear cycles over time. And even over this, if you kind of interpret this data, in the 1930s and then the 2000s, you had whole decades when S&P went down over that decade. So I think the key here is this works only if you continue in basically investing for very long periods. Over short periods, in any given year, or even in any given decade, you don't really know what you're going to get. But I think the key is if you can continue investing. For example, if in your example, if as that S&P went down, if you had some extra cash to invest and you were able to average down in the 40s, right? The likelihood is in a few years you would probably do better than if you because the market went down than if it actually went up or straight. So it's that's kind of the way to think about it, is really kind of to extend your time horizon.
And there are so many things that impact that, right? And even though there could be economic factors. There's also just things like the pandemic, of course, had a huge impact on the global market. If you look at the 40s, World War II, if you look at different eras of war or instability worldwide, that's going to have an impact on the market.
Yeah, the 70s, it didn't quite go negative, but inflation and the oil crisis really was not a good time. It was another decade that was very, very difficult.
Yep.
Yeah. The great thing about taking something like $10 or $50 or whatever you can afford and buying a little bit of the standard Poor 500 or a single, something like that in particular it's a great educational tool. It's like a little scary while you're losing your $7, but it does make you have to connect the dots to your econ class and history and books you're now reading about finance. You're like, oh, that's what's happening. This is how this works. This is like a great thing to do if you can afford to. Take a little bit of money and just kind of use it as a learning tool.
Absolutely.
A couple more questions, and if we don't get to all your questions, I promise we have more time after we're done with some other pieces, but we have one here.
If you were to put $10 in stocks and then lose the 7, at what point are you like, am I really making that back? Should I just salvage the $3 before it hits 0?
Well, depends. I guess depends on the stocks. Depends on a lot of things. I mean, I think again, to the extent that this is an index or a broad basket, your likelihood of losing, creating permanent loss is quite low. If you're investing in very kind of specific stocks, more speculative stocks, it's possible that they will essentially go bankrupt at some point or nearly go bankrupt. So it's very hard to generalize the answer in this case. I think in general, most companies, it's rare to have, most larger companies don't go bankrupt that easily. And so if you're decently well diversified, even across a few kind of well-known companies, it's pretty unusual to lose all your capital in that.
And then that was, right here. A little bit louder. Yeah, resource for students who are not finance or econ majors.
Yes, that was me. I mean, I did at some point get an MBA, but like I was, not. So I like reading people who feel really accessible and break things down. There's a woman named Michelle Singletary who writes a column called The Color of Money, and she particularly writes for women and people of color and first-generation wealth builders, and really breaks stuff down and makes it super clear. And it's a Washington Post column. It's syndicated, and we included that in the resources. So that's one I really like.
Fidelity is another, Kristen mentioned this, the college uses that, what are they? They're an asset management company. That's where our retirement is invested in. And they have a knowledge center that has a ton of resources. I've read so many, and I've learned a lot from them. And NerdWallet is another one that's pretty popular as well. Okay, one more question, and then we'll continue, and then I promise we'll come back to questions. In the back, very, very back. Investing with ESG. I don't know what that is.
Environmental, social, and governance.
Gotcha. Yes, I do know what that is. Yes.
Yeah. So that definitely a larger and larger percentage of. So we talked about funds, right? So there are quite a few funds now available that do take into account ESG considerations. So they will have certain, they'll do it in different ways. They'll either exclude certain things that would not meet the criteria of ESG, or in some cases, which I actually think is maybe even more interesting, they would be kind of activist in the sense that they'll try to improve how companies think about these ESG considerations. So there's a variety of different approaches, but I would recommend maybe even Fidelity would be, again, an example where talking to them or going on a website, and there will be ways to filter through funds.
There are.
Including, for example, you can take the kind of the S&P 500, but maybe with a tilt or a bias towards ESG. And so there'll be lots of offerings today that allow you to invest that way.
All right, let's get back to some of the other stuff that we were talking about, Boris, and then we'll come back to more questions, I promise. Yeah, so you were talking to us about long-term returns for stocks, but also about compound interest.
So yeah, so there, I mean, I think you asked about Bitcoin because you wanted to make a lot of money, perhaps.
That's right, I want to be a millionaire.
So how do you become a millionaire without maybe as much speculative activity?
Yeah.
So this is where you get your money's worth for today's session. So this really simple but powerful insight is that if you simply, whether it's whether you get dividends or various types of income from an investment, or whether you're investing in a company that doesn't actually send you those dividends, but chooses to take its capital and reinvest back into the business, this concept of reinvestment over the long term is sort of what compound interest talks about, and where wealth can really be created. So this example here is an example of $10,000 up front being invested in call it a bond or an investment that pays you 10%. And in this case, what we're looking at here is what happens in an investment that pays you 10%. So you have your original investment amount, which is the $10,000. At the end of the first year, you get $1,000 from that investment. You can choose to take that out and spend it,
And pocket it.
or you can choose to leave it in and actually take that $1,000 and reinvest it back at that 10%. So then you start getting, in addition to the simple interest, start getting the interest on the interest, okay, or compound interest. So the power of that is, if you think about this over the 20 years, this simple interest grows linearly, $1,000 a year, and you can see that on this chart. The compound interest is growing, is being multiplied by 1.1 over those 20 years. So it's 1.1 to the power of 20. So that's where you get the exponential growth. And at the end of the 20 years, in addition to your 10,000 that you get back, the 20,000 in the simple interest, you get 37,000 of compound interest. And that's just one particular example. Where it becomes really powerful is if you sort of think about this idea of putting money aside that we've talked about, and instead of putting it in a savings account, putting it in the market, which again, not only over any particular year, but over long periods has returned pretty substantial amounts, like 10%. If you put aside $200 a month, you invest that at 10% compounded, in other words, reinvested, over the 40 years, you actually get, on your less than $100,000 of actual cash put in, you get $1.2 million. And that's the real, this is attributed to Einstein, saying that compound interest is the eighth wonder of the world. But it is a very powerful concept. If you look at most wealth creation, it uses this to some extent.
Yeah.
And so I think that's what we really wanted to cover today. And then I'd say to make it even better, perhaps, is this idea that when we think about goods, whether it's electronics or clothing, when there are sales and when those are available at a discount, we rush to the store to buy at a discount. When people think about markets for some reason and markets go down, the reaction is to be scared and to actually sell, right? I think to the extent that we think about this in the long run and realize that over short periods, yes, they can go down. But over long periods, as you can see, this is again the S&P 500, and sort of you can see that sort of the exponential nature of it over time. If you are perhaps buying instead of the $200 a month, but there's slightly more when markets go down, you could potentially compound even better from those levels. So in again, 2008, 2009, would be an example. March 2020 would be an example. And what you do get in the periods after market declines is usually at least 2 or 3 years of kind of supernormal, like better than average returns that you gain from. And then just to finish off this section, again, Warren Buffett, he's one of the best investors in the world. His famous quote is, "Be fearful when others are greedy, and be greedy when others are fearful." So be greedy when others are fearful. When markets go down, don't see that as a reason to sell. Think about perhaps buying more in those situations.
Yeah. Boris, if we can go back to the compound interest one, the one with the Albert Einstein quote. I love this because in thinking about social justice and thinking about the eradication of poverty and wealth creation, this is often almost like a really well-kept secret, right? And this is the idea that if you graduate college at 22 or 23 and you start investing $200 at 63, which is about thereabouts retirement age, you'll be a millionaire. You'll have $1.2 million in your investment account. The best part is you can live off of the investment, the returns of that investment, meaning you're not touching your $1.2 million. You're living off of that, of the returns of that investment. And if the day that you die, you pass that on to your children or your loved ones, then you're passing them $1.2 million. And that's just compounding on your compounded interest, and it's snowballing that wealth. And that's how wealth happens in America, right? Yes, a lot of people are business owners and create businesses and then become enormously successful, but most people will become millionaires by doing this than actually being business owners that can create a Microsoft and then sell it for millions of dollars, right? And this is not behavior that is seen in lower income families. For me, growing up in Mexico, my family used to save up money in cash in our home, and we had it stored in a specific envelope at the house because my parents had no understanding, and to this day have no understanding of the value of compounded interest, right? But wealthy families will because they have access to investment experts and people that can tell them what to do.
Another point on keeping the money in cash, as we've all seen, goods become more expensive over time.
Inflation.
So keeping money in cash also means that that money is essentially going down in value over time, and what you can buy with it goes down in value. So some level of investments is almost necessary to keep up with with inflation.
Yeah.
So it's another way to get to the same place.
Yep. All right, we have a little bit of time for some questions. What are your questions? Yeah.
So actually, don't really understand the compound interest. Is that money that you leave in the bank, or is it money that you invest via a company?
Yeah, the word interest is maybe a little bit misleading. The concept applies to all types of investments. I mean, it's what you do in a bank, you just are very unlikely to get a high enough level of a rate of return in order for this to work. Typically, you do have to put the money at risk and invest it in something like stocks over long periods of time. But yeah, the idea is really to, whether you can invest in a single company as long as that company is managing it in a similar way and reinvesting into profitable businesses and growing it sort of internally at that 10%. Or you can invest into let's say, something like an S&P 500 index, but reinvest any dividends or any income that comes from it back into that investment. The whole point of it is to leave the money in the account and to reinvest over time.
So it's not just money lying there, it's kind of money that you have to
Risk.
put some effort into.
Well, you don't really. For example, if we're talking about S&P 500 or most other types of investments in a brokerage account, for example, you can just elect sort of automatic dividend reinvestment. And so they will automatically, every time there's a dividend, will buy more shares of the same investment. So it doesn't require that much work.
So to give you a real life example, at the college, we receive our retirement contributions through Fidelity. I'm 35 years old, so when I'm receiving my retirement, I chose a plan that is for a 30-year investment plan, because if I retire at 65, that sounds. So basically, all I do is I just get that money into that account, and then they are balancing it and they are distributing it in a way that makes sense for a 30-year investment plan. Any other questions? Yeah.
I mean, I would say you can kind of separate out to some extent what I'm making right now and what I'm living on and my investments. And so when you think, crash, which is quite a scary word.
Yep.
One good thing to know is that people are always getting jobs, even in the worst economies there are. People continue to hire. If you look at any given cycle where it's like, oh my gosh, people are losing jobs, the places we saw this week that laid off 10,000 people have jobs posted right now,
Yep.
and they're going to fill those jobs. So it's usually a matter of, unless the company's in the world's worst trouble and they're laying off 95% of their people, then we might not want to work there. A lot of times they are just like, well, we don't need as many of these people, but we need some more of these. And so in any of the worst kind of economies we've lived through, like, people are getting jobs. So I think I would focus on like supporting myself and my needs right now in the moment, mostly through like how you're employed, and then try the best you can to park that retirement money if you're young and be like, it's going to be okay. My 50 to 43, it's going to come back up to 50 and then be 60. And then, some of the trick, if you're not an active money manager of your own money, is the discipline to park it and not stare at it every day. That's my pragmatic advice.
You'll be 22, 23, 24 when you graduate from college, right? So if you're thinking about retirement, you're talking 40 years. The economic conditions 40 years from now are going to be enormously different from what they are right now. Yeah,
it's hard to believe sometimes because I think, it's hard until you live through some of these cycles too. There's some statistic, and I don't have it on the top of my head, but if you invested $1 right before the stock market crash of 1929, like what it would be today. I'm like, do you know? Somewhere there's but it's just like these graphs. It's like when things are at the bottom, it looks pretty scary. So I would just separate out, what do I need to live today and how do I make that work for myself? And if that's feeling kind of uncertain, and then like long-term is a different question in a way.
and again, to put things into perspective, when we're talking about market crashes, we're talking 4, 5, 6, 7, 8%. So it's not 50% of the worth of all of the stock market, right? It's a lot of money, but it's actually a little bit more nuanced. There was another question. Yeah.
So you talked a bit about credit score, and the thing about not having a credit card
Yep.
that actually, in a way, negatively
Yes.
affects your credit score is very much news to me. I've stayed away from credit cards because I was told it was nothing.
Yeah.
But how could you have a credit card, and like what sort of purchases could you make that you can be sure you'll pay off the debt?
Yeah.
So you can bring up your credit score. Like how
Yeah, I love this question. I'm a little bit of a credit score nerd, and I had a goal for myself to just have the highest credit score that I could have, and I've worked really hard at this. It is ironic, and you would just not think this is the case, but this is just the reality of the market that we live in. If you want to have access to cheap loans, you have to have a good credit score. So for instance, for me, I think I own, 7, 8, 9 credit cards with different companies. I don't owe those companies money equally, but I do use them in different ways to kind of be able to keep my credit score going and to increase my credit score so that when I go and get a car, I'm getting the car at 3% versus someone that doesn't have a credit card, doesn't owe money to anyone, but they're still getting the car at 7%. And that, over 4 or 5 years, you're talking $5,000, $6,000, $7,000 difference. So one of the things that you can do you want to talk about the strategy you mentioned?
Sure, yeah, I mean, I think, too, it depends on you and your ability to manage stuff, too, right? Like, there are the people who are like, I signed up for Hulu because then I'm going to ditch it the next month. I'm like, I never remember to ditch Hulu the next month. I could not keep track of 6 things if my life depended on it, I could. So I think a simple way is to get a credit card from someone very, very, with a good reputation, see if your credit union you just joined has something or can recommend something, or you go with like Capital One or some like very defensible company. or your bank, and you put your cell phone on it, just your cell phone, or just your cell phone and your first grocery bill of the month and no other ones, or whatever. You do something that's like super predictable, sometimes just automatic and beautiful, and then you've got this track record of like every month this woman borrowed $20 and paid back $20. And then you don't have to throw everything on it, especially if you're someone whose discipline is like, I use cash to keep track of like what I have so I don't overspend. That's a great discipline. The only problem with it is that the credit agencies can't see you doing it, so you don't get credit for it.
Yep. So for instance, for me and my family, all of our day-to-day expenses, gas, when we go out to eat, groceries, I put them on my credit card, but every single month I pay off my entire credit card. So I have to make sure that we're not spending more than I'm bringing in on my monthly income, right? So that's where the discipline comes in, because I could borrow $20,000 on my credit card, but I don't get $20,000 a month, right, from my job. So I have to make sure that it's $2,000, for instance. And then at the end of the month, I pay it off. I accrue no interest, but the credit card, the credit score companies are seeing my activity and they're increasing my credit score. Yeah. I don't know.
I would say, once you have a credit card and you use these tools like annualcreditcard.com, there are tools that will help you see literally what you can do. I think
Yep.
Capital One is doing this for me currently, and probably one of my other things is like, here's your credit score, and if what happened this month, and it's like, oh, you ran a credit card check because you were looking to maybe buy a car. Like that dipped your thing by 1 point. Some of these things are very small. So there actually are tools that are like help you look at yours and improve it. I don't know. I would worry, I think, a little bit less about that and more about picking something that I felt like was totally reliable. I totally knew I could pay it off in full every month and just establish a pattern. Because, when I was in college, numbers even like theoretically like 1,000 were hypothetical.
Yeah, that was too
Numbers
much.
like $10 I could wrap my head around. So I'd put something that cost like $10 on it every month and pay it off.
Yeah. And don't rely on credit cards if you don't have your budget first, right?
Yeah.
You need to know how much money you're bringing in and how much money you need to have every month. And then you can start working with these other more complex tools like credit cards. Because you can get into a lot of debt easily with a credit card.
Yeah.
And by the way, interestingly, that compound interest, it works for us when we're investing, but it also works for the credit cards the other way around. If that's debt can also increase that same way, right?
Good point.
If you owe $200 a month every single month,
It's
you're
bad.
gonna after 40 years you're gonna owe $1.2 million of debt, right? So it works the same way.
It all works both ways. That's a fascinating thing.
Yeah.
Yeah.
Any other questions?
We have some over here.
On the topic of credit scores, I think on a previous slide it said that like check your credit score frequently or improves your score. I was wondering why that was, and if there's any way to like go around that.
Yeah, the free annual record, the web link there, annualcreditreport.com. The free, that's not going to do anything bad. You're just checking once a year. You might be able, I'm not sure. What it's really looking for is like, this person is shopping cars hard. Like, what are they about to do that I should be worried about? So it's really like when you are having a sort of a little mini transaction, which you have to do if you're about to borrow much money, the person's gonna be like, are you credit worthy? And you go to the next store and they do the same. If you do like 27 of those in a row 1 week, they're gonna be like, what is happening? So I wouldn't worry too much about like using that tool to check your own credit card score, go for it. But I would worry about like, just think about it if you're like shopping apartments, which ones you actually like go ahead and do that with versus which ones you were just like, that was interesting, I have no interest in this, walk away, don't even like start, if that makes sense.
And you can ask the apartment person or whoever, is this going to hit my credit
Yeah.
score, my credit report? And they'll tell you.
Yeah, are you gonna run a credit check on me? Oh, no thanks. Yeah.
Yeah. You had another question, yeah?
In terms of a like actionable plan, what are some concrete steps we can take to start investing in, let's say, like the next week or the next month?
I guess there was an example of I think companies like Fidelity and Schwab, but they might have sort of apps.
Yeah, there's a new
available.
app. It's called Bloom. I haven't checked it out though, but an alum who was working at Fidelity told me about it. I think it's more entry level, kind of like I just want a little account. You can also do that by just going around within. There are a number of places you can create like a pretty small initial investment. And I would probably start first with making sure you have a bank you like. Back to my credit union thing, like a checking account and a savings account. And right now, a savings account should be paying you a little bit, even if it's like 2%, 3%. Go ahead and get one of those. Don't get the one that pays you nothing. Get the one that pays you like a little something.
Yeah, so it's a CCS if you have money that you're willing to risk and you've taken care of your debt and
Yep.
you have some money in savings for emergency and say, let's say I have $50, that's a great example, right? $50 is not a whole lot of money. You can potentially lose it. And then you would just choose either an index fund like the top 500 companies, the S&P 500. You can do an index fund like maybe women-owned businesses, and you can just invest in those. Or we joke that both Kristen and I at different times, we've bought one stock of Walmart. For me, it's because I spend so much money in groceries with my family that I always say I just wish I owned stock of Walmart because we're just spending so much money there. And I did one time, not like 2 or 3 years ago, it was like $184. And I own one stock, and I'm partially owner of Walmart, as long with 5 million other people. And it goes up and down a little bit, up and down. But grocery stores are pretty safe, right? Like people have to eat. That is a very different investment than a startup that no one has heard of, and that could crash and burn tomorrow.
Yeah, so I think, it's like, it might be worth thinking about, is this the beginning of my long-term retirement plan, in which case I want to be pretty diversified and I want to start to pick a company that I think is going to do a good job managing my money and maybe I stick with them forever, or not. Or is this like a learning, and so I'm not ever counting on it paying off, and I just want to like have an incentive to watch something and pay more attention to the news, and you could kind of go with either of those, and that's a great, I think, way to start.
And most of these brokerages allow you to buy, even if you want to buy a company and the share of that company is worth $200, $300, you can actually buy half a share or a quarter of a share. Most companies today allow you fractional share ownership, which allows you to buy. If you want to, I do think from an educational point of view, buying a share of a company that maybe maybe your parents, one of your parents works there. It is very educational, and maybe learning more about that company, maybe reading its annual report, following what maybe its quarterly earnings announcements. Then you're really starting to learn how to invest. And that you can do with $50, $10.
Yeah.
Yeah. And also, you mentioned Warren Buffett. I quoted a couple times, and people are asking for resources. I would say, actually, Warren Buffett is very readable, very accessible.
He has a lot of books.
For someone that brilliant, like, you can actually make sense, and if you want a sort of a basic finance education, believe it or not, I really think great reading.
And there are two ways you can learn about him and about what he's done. There is a book called The Warren Buffett Way, as an example. There are lots and lots of books on this topic, but that would be one easy one to start reading. But then also you can read what he writes. So every year he will write an annual report for Berkshire Hathaway, his company. Right. And reading, he does it, I think he says that he is writing it for, as if he's talking to his sister or his aunt. And so it's written in a relatively accessible way, and it is wisdom. There's more wisdom per word than almost any other thing I think you can read.
One more question. We have time for maybe one more question. Yeah, right here, and then we'll get to you.
Are ethical and sustainable investments always going to be like more riskier?
Not necessarily. I think the data on, so again, it's a similar question to the ESG questions earlier. The data on that is somewhat mixed whether or not some people actually think that you do better investing in those companies. They're more, in general, you want to invest in companies that are sustainable, right, in various ways. And some of, ESG touches on a number of points of sustainability. So I'd say it's hard to say whether it's better or worse, but I wouldn't call it necessarily speculative, especially if it's not a single company, but it's a portfolio of companies that are sustainable.
And the older the company, the more data you have to make your decision, right? If the company that you're talking about is 6 months old, not a whole lot of data to be able to know how you're going to make it. Yeah. Okay, last question.
I just want to know your guys' opinion on timing savings accounts at online banks. I'm thinking of Ally, for example.
Yeah.
So I know you guys mentioned credit unions and how that might be a good idea, but I don't know what you guys thought about more about online.
He's asking about high yield online savings accounts, which are banks that don't have retail brick and mortar establishment. They're only online.
This is where behavioral economics comes in. Remember I said we're not all rational actors? I like to be able to walk into the credit union. I like to know it exists. I like to know it has a reason to continue to exist forever. I like to understand its mission. I like to be able to read up on it. And so, I mean, my relationship with some of these is largely online where it takes place. But I like there to be people and stuff I can read.
I'm different. So
yeah.
Discover, for instance, is an online bank. They've been around for a long time, and they have high yield savings accounts that pay a lot more than like Bank of America, for instance. And I've used them, and I've had a good experience with
Yeah, I'll sacrifice my extra 0.2% just to have a person.
So I guess I'll go in the middle and say, Capital One, for example, I was just looking this morning. I mean, a number of the banks that you can walk into might have similar rates than the online banks. The other thing you can think about is there are CDs now that are relatively short term that you can get with any bank, and they're very comparable rates across different banks.
What's a CD, Boris?
So it's a certificate of deposit. So basically what you're doing, it's kind of like a savings account, but you do have some restrictions on how much, on how long you have to keep the money in that account. By the way, there are some CDs that allow you to take some money out, believe it or not, even before that, the 3 months or the 6 months that you sign up for. But yeah, those are available in most banks, and they have very good rates. So I'm also a little bit skeptical on the, maybe wrongly, but a little skeptical on the online-only banks. But you can achieve similar rates through other banks. So a site like, I think bankrate.com is a good site to go and compare different rates and see different types of institutions that offer them.